Well guys, it seems like the pain in the stock market just doesn't want to end. After what was a very positive FOMC meeting on Wednesday where interest rates were raised by just 50 basis points, the market decided that it wanted to put much more emphasis on the much more lagging indicators like the US labor productivity data. So why exactly did the Nasdaq pull out its worst day since June of 2020 this week, and what does history really tell us about the potential stagflationary period we're about to enter? Let's discuss all of that and more in this video. But before we get into it guys, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So starting things off with the FOMC meeting, which is when we expected Jerome Powell and the rest of the committee to raise interest rates by around 50 to even 75 basis points for May. Now obviously this could be taken in as two different things. First being the fact that the Fed might be putting itself even more behind the curve when it comes to its efforts to fight inflation by being a little bit more dovish with raising rates. Or secondly, it could show that the Fed has some inside data that shows that the economy is already turning over into a recession right now, which could in fact bring inflation down by their summer 2022 targets. And as you guys can see, it seems like the stock market specifically has been trying to price in the worst case scenario over the past month after the Nasdaq had its worst month since 2008. And well, what exactly is that worst case scenario? It's the fact that we could be going into a recession in 2022 in the second or the third quarter. Because right now the Fed's fund rate is sitting at around 1.5%, which means that if we raise by another 1.5%, that puts us at a rate of around 3%, which is going to be a significant shift from the rates that we experienced in early 2021. But the good thing here is that lagging indicators like the US productivity data are supporting the fact that we might already be starting to go into a slight paper recession right now. If you guys remembered a few weeks ago, we recently got the GDP data for the first quarter, which fell in at negative 1.4%, which was a big surprise for a lot of investors. And the reason why that was actually a good thing is because since the stock market is always forward looking, if the recession's already starting here in Q1 and potentially going to Q2, then the stock market is probably going to be setting up for its vision of Q3 and Q4. And although it's not clear, I think this could lead us into a potential double dip paper recession, which is where we first see some lingering effects of the big comparisons we had to make in 2021 and 2020 when the labor market was at its peak. And obviously now, since the Fed is coming out and raising interest rates to fight inflation, which is exactly what was caused by that high labor market, we could start seeing consumer end demand for products and goods and services start going down, and that could be reflected in potential GDP declines in the fourth quarter or even in the first few quarters of 2023. And so the key takeaway for me is that if you're a retail investor that's really struggling with their portfolio in this kind of market, just remember that you're not alone and that there's hundreds of thousands of other investors that are also doing very poorly with their portfolios. And as you can see, mine today had one of the most volatile days that I've ever seen over the past 2 years. A lot of that has to do with some of the earnings reports that these companies have come out, and a lot of that simply has to do with the insane options volume that we're seeing the markets trade recently. But the key thing to keep in mind is that whenever fear and volatility is very high, as seen by the VIX, it has always historically been a very good buying opportunity for the medium and long term. Now obviously in the short term and in the moment it looks very difficult to continue buying the dip, especially if you've run out of cash, but the real investors that succeed exercise patience and they have the discipline to control their emotions during such a tough market. And one of my strategies is that whenever the VIX is above 30, I always try to add to my positions on my favorite companies. And another one of the reasons that's personally keeping me somewhat sane in this kind of market and keeping me bullish and optimistic for 2023 and the latter half of this year is the fact that a lot of retail investors are already given hope. And we're starting to see posts like these where retail investors want the stock market to crash and they're comparing it to things like 2008. And if I'll be honest, that is one of the most bullish indicators when retail investors themselves have turned bearish because of just how slow the market has been. If you had asked any retail investor to short the market in 2020 or even in early 2021, all of them would have laughed in your face. But now that the market's been crashing for the past 6 months, everybody's come out of the holes and they're trying to now short the market or wish that the market continues to go down more because they probably panic sold all their positions. And as you can see, at least based on the NASDAQ, the first quarter recessionary data that we're seeing this year is potentially already priced into the market as investors really started selling off stocks right at the start of 2022. And on top of that, if you guys remember the 10-year, 2-year spread that so many people were talking about in March and April, well, that thing inverted for a very brief amount of time at the very start of April. And so if this indicator is meant to be taken as true, then there's a very high likelihood that in the second quarter and the first quarter, we are going to see a paper recession. And the interesting thing here is that if you see the length that the yield curve stays inverted has a direct correlation with how long the recession actually lasts. And as you can see, although in 2020 this could be more of a coincidence than something materialistic, the yield curve did invert for a very short amount of time. And as you can see, the 2020 recession also did not last that long. Whereas in 2006 and 2007, the yield curve inverted once, it went back up, and then it inverted another time, and it stayed there for almost 2 years, which is obviously right before the 2008 and 2009 crisis. Whereas in 2001, we saw the yield curve also invert, although for a shorter amount of time than the one we saw in 2005 and 2007. And as you can see, that directly correlated with a shorter recession period in 2002 and 2001. Now, obviously, the question that a lot of people might be asking is why is this a good thing for the market if the yield curve is inverting and signaling a potential recession in the short term? Well, the simple fact of the matter is that the stock market has already sold off so much in anticipation of this recession happening that if we actually entered the recession sooner rather than later, and it turns out to be not as bad as many investors had expected, which has historically been the case, then the market could most definitely start rallying during that recessionary period. And just to somewhat put the NASDAQ sell-off into perspective, as you can see, the biotech companies within the index are trading at record levels underneath their cash positions. For those that don't know, the biotech sector is by far the most riskiest sector within the NASDAQ. So what this shows is that investors are in a very extreme risk-off phase. So if you own any growth stock that's unprofitable, and if you've made it through the past 6 months, then you should definitely pat yourself on the back because it's been a historically difficult period to be a growth stock retail investor. And as you can see, every single time that this specific index has peaked has always been very great buying opportunities, like in 2009, in 2017, and at the end of 2019. And yes, although there's always a chance of a Fed rug pull coming in the way of a 75 basis point rate hike in June or even in September, we're already starting to see some inflationary indicators like used car prices start to come down, which could fall in the favor of recessionary fears kind of peaking out in the summer. Because obviously when inflation is very high, consumers tend to naturally bring down their demand and their consumption, which obviously leads to a recession. And the good thing about this used vehicle value index is that it really shows the strength of the underlying factors underneath the S&P 500 and not only the strength of consumer demand in technology plays. And there are expectations that if this index falls another 5% over the next 2 months, then that could result in the CPI index of inflation falling by around 50 basis points. And I can guarantee you that if we start seeing an inflection in CPI, the stock market could definitely see a face ripper rally because the only thing that's concerning the Fed is this inflation number. And if that comes in to be low, then we could start seeing the Fed being easier with monetary policy, and that in turn could lead a lot of room to the upside in risk-on stocks. And the reason why these risk-on stocks in the growth and unprofitable sectors could be the first ones to move is because their PE ratios on a historical basis are trading at 10-year lows. And as you can see, these are price levels that we haven't seen since the 2011 correction, which is when we heard fears about a double dip recession happening. And obviously that never actually came about because the stock market sold off in anticipation of that double dip recession. And the key thing to keep in mind is that this blue shaded area which represents a correction is something that we are currently in for And the key thing to keep in mind is that this blue shaded area, which represents a correction, is something that we are seeing right now in May of 2022 for the Nasdaq. And as you can historically see, every single time we have gone past these blue shaded areas, it's always been a time of expansion in valuations. And obviously when valuations are expanding, that signals a risk on environment, and that is when the market indices are rallying. And as you can see, even if you just look at the indices themselves, the S&P 400 and 600 mid and small cap indices have been performing very poorly for the past 1 year, ever since the start of 2021. And although the S&P 500 did have a very nice 2021, that index is starting to pull back because we're seeing big tech valuations start to correct. And unfortunately, if the market starts rolling over, that is going to start rolling over into some of the more beaten down small cap names, which is why stocks like Plug Power, NKLA, and even STEM have been getting absolutely destroyed over the past 4 months, even though their valuations are relatively cheap compared to how much they're going to be growing over the next couple of years. And as you can see, historically, the small and mid-cap stocks always tend to follow what the big tech stocks are doing, although in the short term, during recessionary fear times, there's always a lot of volatility. But anyways, guys, that's just my thoughts on what's been going on in the market over the past week or so. Let me know down in the comment section below your guys' thoughts on what stocks you should be buying on this dip, and whether or not we actually see a recession in Q2. But anyways, guys, make sure to drop me a thumbs up if you found some value from this video, and I'll catch you guys in the next one. Take care.